Well, welcome back for the next installment on the Wealth Optimizer training. In this particular class, we're going to actually get down into an actual property. So I'm going to give you a property. Hopefully this will come with the supporting material. I actually have the handouts, but it'll be a PDF, so you can actually look at a pro forma that was put together for a property that was on the market probably from 2016 till the present. There's an offer on it now, so it's been on the market for a decent amount of time. And this is something that I've used with multiple classes, going through, pulling it apart, looking at the different aspects, as if it's a real property on the market. How do we do that? As we go through, I'm actually going to be using, and this will be as part of the handout as well, but it's going to be a simple one-sheet calculator. Now, I know you don't want to do this ever again, right? You do it once and you're like, okay, I'm good. But this will actually do all the calculations that Wealth Optimizer is going to do, the tool is going to do for you. But I think it's important to understand how we're putting this together, because when you understand how we put it together, you'll understand problems as they arise. You'll better be able to manipulate the inputs to get what you're looking for and to find the opportunities. So with that, let's get started. So we're going to look at, essentially, its title, How to Analyze a Property Quickly. This is not going to be quick. It could take us an hour to get through this analysis, but understand that most pro formas we can put together in literally 5 minutes. What takes a little longer is to dig into the details and make the real estate deal. Remember, we talked about this before. Real estate deals aren't found, they're made, right? They're not just going to show up in the MLS and say, hey, this is a great deal, buy me. And if they do, you're like, yeah, buyer beware, right? We want to do the numbers and understand what it is they're trying to sell us. Okay. Again, we're always given that disclaimer, talk to your tax and legal professionals before you buy property. All right, so what I've done is this particular, it's a prospectus, and I've got, this was I think like 10 pages, I shrunk it down to about 6. This is a 48-unit apartment complex, two-story building. It's got 28 garages. Utilities are all included, are all paid by the landlord. It's got appliances are in place, and they've given us the 2016 actuals along with what they the pro forma for what the realtor or the seller thinks on how this property will perform. So we'll go through and we'll look at it, and then we're going to fill in our one-sheet calculator. Or you could actually go to Wealth Optimizer tool if you have access to that already and actually start filling these things in and see what comes out the backside. But you can calculate it by hand, put it into Wealth Optimizer, but at the end of the day, we want to see how'd this go. Okay, so let's look at it. This first section is essentially a screenshot of the prospectus. And so we've got 2016 actuals in the one column and their pro forma in the next column. And then down here, the second screenshot, I have how to fill in the one-page sheet. Down the road, we'll look at how to fill out the Wealth Optimizer tool. So the price, they're asking $3.2 million for it. In 16 actuals, they're putting a 20% down payment. That's pretty simple. They have a loan amount of 4.5% interest, which is a little low, right? That's 2016. The interest rates have come up since then. 20-year amortization. We're going to match that in our numbers just so we can check their math. They got debt service of $194,000. This is going to be principal and interest. And then the monthly debt service, of course, divided by 12 is $16,000. And so to fill this out, our down payment is 20%. Put in our purchase cost of $3.2 million. Take the 3.2 times the 20% gives us a $640,000 down payment. Financing, go online, get an amortization schedule, and pop that in, and we'll see at 4.5% at 20 years, we end up with $16,000 on a monthly debt service. Okay? Very straightforward. And of course, we know that we can play with these numbers too, and that's what's so great about putting it in a calculator is we can say, hey, what if we got a 30-year loan? Hey, what if the interest rate jumps up to 5%, or what if we got it for 4.25%, right? All those things become possible. The next section on the one page is a depreciation schedule. Now, normally when we're running pro formas, depreciation is the last thing on our mind. However, it comes next in the one page, so we're going to cover it now. Obviously, Wealth Optimizer is going to do it for you. But you will have to put inputs into Wealth Optimizer in order for it to kick out the output. So let's look at how we come up with the inputs is essentially what we're trying to do. So the screen capture here on the right is the actual screen capture from the county website for this property. And what we're looking for, you'll have to find your own information for your state and city or your county. But essentially what we're looking for is non-agricultural land value, $216,000, and the building value is $1.7 million. So those are the two numbers I'm looking for. And if you remember from the depreciation conversation, we were using the assessor, the county assessor's valuation as our starting point, right? to do our MACRS system, to divide our property into these 4 buckets. They've divided into 2 buckets. So here we've got land, building, add the 2 together, we get our total, and now we can figure out what our ratios are. So our ratio, if we take our land divided by the total, 11% of this property is land, 89% is building. Straightforward. Now, what we want to do is we want to take it, we want to split it into those additional buckets of personal property and land improvements. And again, I'm going to go fast through this because this is explained in detail in the depreciation class. In this case, our purchase price is $3.2 million. Okay, we're going to go with that. We're not going to talk about, what if we get it for 3.1. Let's go with the asking price. If we know that land is 11% of the value, well, let's take the 3.2 million times 11%, we get 352,000. And continue on down. We got the personal property. Well, how do we come up with 144? And how do we come up with land improvements of 320? Okay, so let's look at that quick. This will be a review, but I said we looked at the, I think there's like 58,000 square feet in this building. I said 2/3 of that's carpet, even though I've never been to the property, but I can kind of see from the pictures. 3,600 square feet of carpet times $2 a square foot to install it. That means there's about $72,000 worth of carpet. Then there's 48 units for appliances. There's 3 appliances, and actually I discovered there's 2 more. There's fridge, stove, dishwasher, and then I discovered later that washer and dryer are also in the unit. So this really, if I was going to do this again, I'd update it to 5 so that we can, again, break even more out of that building and put it into personal property. But let's go with 3 for this example. 3 appliances, 48 units, times $500 a piece, gives us another $72,000 for appliances. We add both of those up. 72 and 72 is 144, and 144,000 divided by 3.2 million, right, means that the value of the personal property is about 4.5% of the entire project. And then how did I come up with land improvements? I just guessed. Okay, I didn't get into it and didn't figure it out. I said, hey, there's sidewalks, there's driveways, there's all these different things. I threw 10% at it. If we wanted to dial that in, we could, but for example purposes, I threw 10% at that. 10% of 3.2 million is 320,000. Okay, so there we go. So that's how we came up, and then we can figure out what the building is. It's going to be whatever's left, right? So 11, 4.5, and 10%, that means that 74.5% of this entire project is building, and then we can extrapolate from that the actual value of 2.3 million. Again, go back and review the depreciation class, and you can look at this in detail. Our last step in the depreciation, if you remember, is to calculate a cost. So if land, remember, doesn't depreciate, we don't get any tax benefits for land. That's why farmland and stuff, it doesn't have the tax benefits. Personal property, in the first year, we said this is the value of the personal property, $144,000. In the first year, based upon the IRS tables, we get to take 20% of the value. So we take 144,000 times 20%, gives us $28,800 in depreciation. And what we did here, if you remember, depreciation was defined as converting an asset into an expense over time. And so what we did is we took our asset of 144,000 and converted 20% of it into an expense. Okay, and so now this becomes an expense to the property, which then reduces our tax liability. And we do the same thing for the building, multiply it across, and for the land improvements, multiply it across, and then add all of our depreciation. And depreciation gives us an extra $127,000 in expenses in the first year. Okay, so now let's analyze and look at the income side of this particular property. So they've given us actuals and pro forma. So we've already determined from previous classes the gross scheduled income. This is a somewhat of a made-up number, right? You can put anything here you want, but it ultimately comes down to what do you think the market rent is for all of the properties for the entire year. You could be right, you could be wrong, okay? So you want to be pretty much legit. So we don't know if they're right or wrong here, but certainly we could go do a rent analysis and figure that out. But let's take them at their word, okay? Other income, $18,000, that seems like a lot. We'll want to know what that is to see if that's repeatable income, and we're going to find out that it's not. And so we might want to take that out, but that's getting ahead of ourselves. So our total scheduled income is the gross plus the other, gives us $461,000. And then they got this vacancy line, 2016 actual. They've got $70,000 in the actual vacancy in 2016. And then when they do the pro forma, they say, well, we're just going to put 5% vacancy for the performance. That's $23,000. Well, that tells me that the actual vacancy is in that 14, 15% range, and alarm bells are going off, right? Now, maybe that's the vacancy rate in town, but that's a lot of vacancy. And here's the key, right? If we know that the NOI with the cap rate is going to determine value, what does the seller want to do? They want to get that NOI up as high as possible. So that means they got to get their rent up as high as possible. That means on their pro forma, yeah, I only want 5% vacancy. Yeah, so do I. But the reality is it's 16% or 15% vacant right now. Why? Why do I want to pay you, the seller, for your vacancy, right? You want to sell me an occupied property. I don't want to, you're not selling an occupied property, right? You're only able to get it 85% occupied. So this is a big, big red flag for me, even though it's very mundane. It just kind of just sits there, just in plain sight, hiding in plain sight. So on their actuals, their gross income $390 and their pro forma $438. So here's the breakout of their income. So let's dive into this. Some things we're going to care about, some things we don't. Obviously, if I'm analyzing this for myself versus a client, there's different things I might do. They've got late fees in that income. Obviously, you know, if your company is collecting late fees, you don't want to put late fees into the income. Cleaning charges, $316 is pretty minor. Legal charges, $851. That looks like it's probably an eviction. Forfeited security deposits. This one I'd key in on, forfeited security deposits. Generally speaking, you guys understand how AppFolio works, is you have a charge and then you apply the security deposit to that charge. And so that becomes damage withholding income of some sort. It's not really a forfeited security deposit. And usually whatever's here, there's an offsetting charge, right, in terms of cleaning, carpet cleaning, and what have you. So just be aware of that. It's not necessarily wrong, but just pay attention to it. Tenant application fees, you know, if we're a professional manager, we're collecting those, but there's no expenses then either to the owner. Bad debt recovery, this one's one I want to key in on. Bad debt recovery, so if we're talking about an accrual-based accounting system, you might have something like bad debt. Obviously, you know, we're doing a cash-based system, so we don't really have a bad debt thing, an account, but this hardly is income to the buyer, right? I'm not buying his bad debt, and certainly that's not income. I've got expenses that offset that already. So for sure, when I'm doing the pro forma, I'm pulling that number out. That is not part of the income in my mind. Garage and parking space. Here's another one. You got $3,500 and there's 28 spaces. Well, based on what you can get for garages, we should have way more money in this. So while bad debt recovery is probably bogus, I want to get rid of that, I think there's opportunity in the garage one, in the garage space, that either he's not collecting rent, they're too low of rent, or they're not occupied. Is there a way to get tenants to buy them? Is there a way to use the garages maybe as a rent incentive, right? To say, hey, I'll include it with the rent. Look at what a great property you have. You get a garage included with the rent. Is there a way to leverage those garages and make more money? So anyway, we get all done with that, and we're going to basically say our annual rent, we're going to take the gross scheduled along with the garages, because those are the two legit rent numbers. We're going to put that in our annual rent amount, and then we're going to calculate 8% vacancy in this particular model, which gives us $410,000 net rent, essentially, our gross operating income. In the Wealth Optimizer calculator, you're going to want to put as income anything that's income to the property. So not only rent, but coin operation, pet rent, all those kind of things. Anything that's coming into the property is income. You want to include that as income. So now let's look at the expense side. And you can use their numbers, but it's hard to find the opportunities if you're always just using their numbers, because the rest of the world can see their numbers, right? This is published online, it's public information. That's not going to tell you where the opportunities are. So you want to dig in a little bit deeper. So what we did was, or what we're looking at here, is the property taxes for 2016, $40,000, pro forma, $38,885. Well, we looked it up, sure enough, it's $38,885, so good. That's a good number. It decreased for whatever reason. Property insurance, this is interesting. Their actuals was $16,000, their pro forma is $10,000. Well, the question I have is, what's happening here, right? Normally things don't get cut by that much. Did he get a new quote? Did he crank up his deductible, right? What's happening here that you can get that kind of a discount? So I'm going to want to get my own insurance quote. Administrative expenses, we don't know what these are, but my guess is this could be property management costs or an on-site manager or that kind of thing. We'll want to dig into that deeper. Utilities, there's a huge opportunity here at $63,000. The landlord's paying all utilities. What happens if we could put this on a RUB system, right? Obviously, we'd have to lower the rent a little bit, but would there be opportunity here? Operating and maintenance expense. This is not near high enough for this property, right? But what I think is happening, if we jump down to this payroll expense, we got $45,000 in payroll. It's entirely possible that they have an on-site maintenance person, okay? So again, we're looking at their stuff and it's like, yeah, caveat emptor, right? Buyer beware. We're using their numbers, but they're kind of fudgy. We're going to kind of use our own numbers. Grounds expense, we've got probably lawn and snow. So at the end of the day, you see their total expense there. What we're going to do is we're going to just do our own numbers. We're going to take real estate tax of what it is. We'll take insurance for their lower number, again, with investigation. Repairs, I think I put that at, it's essentially 1% of the building value, probably about 8%, 8 to 10%. Utilities, we took their number. Leasing, right, I figured out what that would be for us. I put in our management fee, and then other expenses would be lawn and snow. So I've figured out what I think it's going to take to operate this property. I come up with $205,000. They had pretty much the same thing, but just divided out differently. Okay, so that's kind of interesting. But this is the 2016 actual versus the pro forma, which they shaved $7,000 off. So notice what they did, right? Income is higher, expenses are lower. What does that do to our NOI? Gets that bigger. That justifies a bigger purchase price. That's what they're after here. All right, so on the one-page sheet, this is what it looks like. We've got our gross operating income at $410,000. We take out our expenses, $205,000, which leaves us with an NOI of $204,000. Then we have to pay the bank, right, principal and interest. So we have to pay $194,000 in debt service, which leaves us with $10,000 in positive cash flow. The next thing we want to just quick calculate on our sheet, we want to look at our debt service, look at our amortization schedule. Again, Wealth Optimizer tool is going to calculate this all for you. But we want to know what our interest is, $113,000, which means that we put $80,000 in the first year towards equity, right? Principal reduction. We own $80,000 more of the property at the end of the year than we did at the beginning of the year. The tenant basically is helping us buy the property. So that's also part of the return. We are going to pay taxes on these $80,000. Then we look at our depreciation. So to figure out our depreciation value, we've got $204,000 is our NOI. We take out our interest, we get to deduct our interest. Then we get to deduct our depreciation, $127,000, which leaves us with a taxable income of $36,000, negative. Okay? If it's a negative number, that means we have two options. One, we pay zero in taxes, or two, if we are a real estate professional, we can put our tax bracket in, and if it's a negative number, it's actually $10,000 tax saved. So depending on who the client is, if it's for myself, I can kind of think about, hey, there's an extra $10,000 in cash laying around to be picked up. If it's a customer that's just a non-real estate professional, I'm just going to set that rate, that 28% to zero. Or I believe Wealth Optimizer will have an option where you can set it from real estate professional or non-real estate professional, and it will automatically take that into account and not give you any benefit for the taxes. Okay? Finally, we can add in a little bit of appreciation. Again, Wealth Optimizer will have the same thing. I'm being very conservative here, just adding 2%. The property's got to work without appreciation. That's kind of a bonus. Again, it's a hedge against inflation. So we get another $64,000 for appreciation. So the last part on that one-page sheet is looking at the return on investment in various different ways. And Wealth Optimizer is going to do this too. And this is where it gets fun, but it's also, you can get a little bit crazy with how many ways you can analyze these things. And at the end of the day, you got to find something that you're comfortable with and comfortable explaining and that your client can understand easily, right? Right now, I think one of the faults of the Wealth Optimizer tool is there's probably too much data there, right? And we've got to somehow simplify it down, make it easy to digest. And we'll get there, right, as we develop this. So here to figure out the return on investment with appreciation, this particular calculation takes all of the benefits, right? All 4 benefits of a rental property, adds them all up, and divides it by the cash you invested. If you do that, this particular property has about a 26% return. If you said, hey, let's not put the appreciation in there, right? Because in a certain sense, my money is worth less and less as as there's inflation. In that case, we'll take appreciation and it's a bonus if we get it. If we pull that out and we add all the other benefits together, now we get a 15.8% return. Hey, that's still pretty decent, or maybe it's not. Maybe you're used to getting a 50% return, I don't know. But again, that return is going to depend on what an investor is looking for, if they think that's good or not. The cap rate, again, we've talked about this in the last class, net operating income divided by the purchase cost. Cap rate in this case is 6.39%. Well, in Sioux Falls, we were talking about how at this time period, right, it was about 6.25 to 7.5. So cap rate kind of falling within that range. And then cash flow is essentially positive cash flow divided by cash invested, 1.6% cash on cash return. Again, Wealth Optimizer will have all of these done for you. A couple other ratios that Wealth Optimizer will have. Your operating expense ratio. Remember, that was expense divided by income. So our expense was $205,000 divided by our $410 income, and we ended up with about a 50.12% expense ratio. Okay, we're a touch over, but we're essentially there. It's within the margin of error, but it's on the high end. Okay. The debt service coverage ratio. This looks at NOI divided by debt service, and what this is looking at is saying, listen, this is the free money, right? This is money. NOI is money after expense or income minus expenses, NOI. And how much excess money do you have once the debt's been serviced? So in this case, 204 divided by the debt service of 195 gives us a greater than 1. So 1.05. Oftentimes banks will like to see 1.25 or even 1.5, because that means there's enough cushion when things turn south, when vacancy goes high, when you have a big expense you have to do. They want to make sure that debt is covered. No matter what, they want to make sure the debt's covered. And so this is definitely a little bit low, right? We'd like to see a little bit more. We could get more out of this by changing our financing, right? If we would expand our 20 years to 30 years, I'll bet this would pop right to where we need it to be. Now, could we find a 30-year loan on this project? I don't know, but there's different ways to get where we need to go to satisfy the bank, to satisfy the investor. And then we talked about the break-even ratio. This is expense and debt service divided by the potential rents. Potential, I say potential because it's not looking at vacancy, right? It's how occupied does the property have to be in order to break even. In this case, it's got to be 90% occupied. So if we look at 2016, where it's only about 85% occupied, the investor is probably putting cash in just to keep the property afloat. And we got to do better than that, because obviously I don't want to be able to do that, and I might not be able to do that, and the property could sink me if we don't be careful. So where are the opportunities in this property, right? Real estate deals are made, not found. We have to actually do some work. We actually have to do some thinking and research to find out where we can make some adjustments to make this a better investment. So let's look at this. Well, one thing we could do is reduce that vacancy from 16 to 8%. That would give us an additional $35,000 in rent. The other thing, we talked about this already, but we can improve those garage rents to get them up to $40 a month, and I think it could even be higher depending on the market, but easily $40 a month in this market. We were getting $3,500 in the pro forma. We could probably punch that up to $13,000 or add an extra $10,000 in revenue, which of course improves our NOI. Obviously, we could reduce the utilities. We could look at efficient boilers, water fixtures, insulation. That costs money, but if we can lower our expenses, the return is probably worth it. The investment is probably worth it. So we'd have to just do the math on that. Also, we could look at RUBS. So if RUBS, right, Ratio Utility Billing System, AppFolio does that quite well. If we implemented that, usually rents have to come down, right? Because rents are up here because all utilities are included. Once we take the utilities out, chances are we'll have to lower the rents by $50, $75 and then pass utilities on to the tenants. And as long as we do that correctly, we could eke out some additional revenue. And then also longer-term loan, right? If we increase from a 20-year loan to a 30-year loan, we actually increase the cash flow by $39,000. Well, that gives us a whole lot of extra breathing room if something turns south. Now, we could take that $39,000 and pay down the debt quicker, but putting it on a 30-year term definitely gives me some comfort that if something happens, we've got some cushion. All right, so let's look at how this would work. So they calculated, the seller's calculations were correct, and you'll see that on the pro forma sheet. But the actual cap rate for 2016 was 5.8%, right, with a $3.2 million purchase price. Well, that's pretty low, right? Generally, an investor is not going to purchase it for that. That puts the NOI at $185,000. So here's what that looks like. If the NOI is $185,000, a 6.5 cap puts the value at $2.8 million. A 7 cap at 2.6, 7.5 cap at 2.4, or 8 cap at 2.3. So you can see what happens is somewhere in here, we know that the market during that time frame was trading somewhere in the 6.25 to 7.5 on the really high side. And so the value of that property then goes somewhere between 2.4 million and about 3 million. They're asking 3.2. Again, maybe it's worth it. Totally depends on what the market's willing to pay for it. Okay? And that's going to change over time. Different markets will pay different things, and at different years will pay different things. So look at what happens if, this is how we find a deal. The performance possibilities here, if we have better management, and I don't know why the reason they have 16% vacancy, but if we can find a way to reduce that vacancy by 8% and increase our rent by $35,000 and increase our garage by $10,000, that takes our NOI, and there's a couple other things too, but it takes our NOI from 186 to 231. Now at a 7.5 cap, we can get at $3 million, right? So if we can see the value and how we can increase the value, increase the NOI, we can buy the property, make those improvements, and actually do very well on this property. And so that's what I've got for you. That's the end of how to analyze a property fairly quickly. It takes a little bit of time. Again, pro formas are quick, they're easy. Doing the research and thinking it through takes a little bit more time. But if you can add that value to your clients, it's huge. And think about how you can grow if you're adding 48 units at a time. So we'll see you on the next one. Thank you.